Hey team, Ben from Pivot Wealth here, and today I'm giving my investment and property market update for February of 2021. Big month in markets, and I'm going to unpack the key things for you to be thinking about and aware of to make smart money decisions for you. Guys, please don't rush out and make any life-changing decisions off the back of what we cover. Strongly suggest you seek out personalized advice before jumping in. So, in terms of a market update as a first step, the first thing that we're seeing is that obviously the Russian conflict causing a lot of disruption to markets. We're seeing big wobbles in the share market, ups and downs as a result of that, and something that's likely to continue over the next little while. I did mention that it's probably unlikely that off the back of that we will see long-term persistent sort of issues there. That's what the history has shown us, but it is likely to cause some short-term disruption. The second thing is that we're seeing that crypto is on the rise. We've got almost 8% growth in the crypto mega cap index over the last month alone, which after the battering that it copped over the couple of months before, that's good to see some recovery there. The tech shares have been seriously whacked, though. We do a lot of work with people in tech, and we're seeing some serious pain there for some companies more than others. Some have weathered the storm pretty well, but a lot have really copped it with a lot of the disruption. A lot of people talking about the tech market being a little bit overblown over the last little while. The property growth has been slowing, and I'm going to dive into those numbers, but we have seen a pretty slow going in the property growth in basically all major cities, a significant slowdown from previous months off the back of the big rises that we saw last year. And the COVID risk is declining. So we're seeing a bit of return to normality. Thank goodness those masks are off. Not a huge fan of that, but good to see. And obviously the impact on markets and economies recovering is a big benefit of that as well. So in terms of the actual markets and the market numbers, the property market update, firstly, Sydney we've seen in the month of February up 1%. That's slowed from 0.6% in the previous month. The Melbourne property market is completely flat, 0% growth off the back of a 0.2% decline in 0.2% increase rather in January. The Gold Coast going strong, 1.9% growth off the back of 2.3% the previous month. Adelaide 1.5% to off 2.2% the previous month. Perth 0.2% off a 0.6% growth in the previous month. And overall across those 5 cities, the total growth in Feb has been 0.3% off 0.8% the previous month. So that sort of talks to some of the trends that we're seeing, that Sydney and Melbourne seem to be sort of capped out, at least in the shorter term, in terms of the growth, slowing down, but still getting quite a lot of movement. The Queensland market, Adelaide, and I think that will continue over the next couple of months at least. In terms of the share markets, we've seen the ASX is up by 1.95% for Feb. That's from a 5.89% drop over the year to date, rather, so far. So total decline 5.89%. The S&P 500, so the 500 largest companies in America, is down 3.8% and in February, and 8.81% for the year to date. The NASDAQ is down 4.15% last month off the back of a 13.5% year-to-date decline, and the crypto index is up 7.92%, but still down 12% for the year overall. Our investment story of the month is rent.com.au. It's a tech platform that helps people set up like subscriptions for utilities and those sorts of things, and track payments for both renters and landlords. We've seen a lot of disruption in that. The current share price it's clearly a penny stock at 4.7 cents, but currently down from highs of 29 cents. So it ticked up. I think it was up 35% or something last month at one point, and a bit of volatility. I reckon one to watch over the next little while. The market watch in terms of things to look out for, the RBA has been calling out that There are slow rate rises on the card, so that they feel and know that there should be some rate rises coming up to slow down some of the inflation or the rise in the cost of living that we're seeing at the moment. But they have called out that they are going to tread really carefully there, because they know that households have borrowed quite a lot of money, especially with property prices going up so much in the last 12 months. So they're going to tread quite carefully. The other interesting thing that I was reading during the last month is that the property supply is still much lower than where it needs to be to keep up with the demand around the population growth over the next little bit. So an interesting one, because a lot of people are talking about this potential decline in property markets, but with the supply still low, that puts a bit of a flaw in terms of any potential issues there, and I think supportive of good growth moving forward. And there was also a bunch of news, and this is prior to the Russia stuff I need to call out, but that in Australia and the economy in Australia is in a strong position to rebound with their capital, the way that businesses are set up, big businesses in particular, property markets, households, household war chest, which I'm going to talk a little bit more about as well. Some of the economic data to think about: Australia, the inflation has been steady at 3%. Economic growth is at 3.9% currently, which is down from 9.6% back end of last year. Unemployment rate 4.6%, down from 5.2% previously. Unemployment growth 2.7%, up from 0.7%, which is a significant amount of growth. Certainly that's something that I'm seeing in the hiring space as well. China's economic growth 4.9%, which we know flows through to the Australian economy, but we are seeing a slowing down there, that they were previously at 7.9%. And the AUD to USD is down slightly, 0.72. As one Australian dollar is buying 72 US cents, down from 73 US cents previous to that. So in terms of the US data, look, in the US, we're seeing disposable income is tracking higher. The GDP growth over there, so the economic growth, is picking up. Employment is growing at a solid pace over there, which is good for the economy, good for households, good for everyone, really. But inflation is still tracking up, and as a result, the interest rates are increasing, predicting some more rate rises out of the US later this year. In terms of the trends that we're seeing in markets and with investors at the moment, one of the big ones is that Aussie war chests are full. So we saw a record savings rates in the pandemic, and a lot of households have saved more than they have in the past and stockpiled a bunch of cash. But now I think it's that bit of, I don't know if it's FOMO, but people think about doing stuff, and then they life gets in the way, things get put on the back burner. But we're now seeing more and more people that are saying that they need to get their act together, put some stuff into place, and actually get invested and take advantage of what's going on in markets, which is great to see. Another thing that we're seeing is that a lot of property owners, for basically anyone that owned property more than 12 months ago, you've seen a pretty massive increase in the value of your property, which means that there's a ton of equity there to unlock. The equity can then be used essentially to invest without dropping in one single dollar of your savings. So we're seeing a lot of property owners that wanted to either buy an investment property or set up for their dream home or whatever the case may be, that they now realize that they're in a position to do that off the back of their growth, which is also awesome. Make sure with that using equity and borrowing to invest is, in my view, a really great way to get ahead faster and accelerate how quickly you do get ahead with your money. But you do need to be quite careful when you do that you've got your risks managed on that front as well. The other thing that we're seeing, tech workers, a big trend at the moment. Tech workers have been pumped with massive RSU tax bills. That's where your employer gives you shares, and when the shares become available to you and the price is high and then it subsequently drops, you're left sort of carrying the can. You get a nice bill from the ATO, but maybe don't want to sell your shares, which have now declined, and you're sort of carrying the bag there. Another one is that share investors are seeing a bit more value in the markets, especially this Russia disruption and the impact and the tech declines before that, tech wobbles, that people are seeing a bit more value where the prices were much higher before. So we're seeing more investors coming back into the market. Property buyers also moving into states. So Sydney and Melbourne, as I mentioned, in the property stats that were really flat growth, and people have been sort of somewhat priced out of the market, sort of don't want to get in at the prices that they're at now, and looking at areas outside of those Sydney, Melbourne markets to make their next property move. In terms of the key hacks and mistakes and client stories over the month of February, the first is our client story of the month. Got a couple here that we've been working with. Income about 300K. Assets and inheritance, they got a chunky inheritance of like $3 million and had some existing assets. So total asset pool about $4 million, saving $20,000 annually. They were frustrated when they came to see us with confusion around their money. Smart cookies, both of them, but found it really confusing and overwhelming. And they were unclear on what actually a good plan means, what being smart with their money actually meant. And what they wanted was a clear forecast for like how their situation was going to progress over time, if they were doing some of the investments they were thinking about, or if they did some alternatives as well. So what we ended up doing going through the process is we put a robust plan in place where they knew that all the bases were covered and everything was wrapped together, and then a system to support that on a day-to-day perspective around saving, money management, investments, and debt reduction as well. Also, they chose to end up pursuing purchasing a couple of investment properties because they had this big chunky inheritance that had come through, and after covering their bases and risk, realized that that was a great opportunity that they could use to grow their assets and accelerate further to set up their kids in the future. But also that they knew that they could really comfortably cover their bases so that they weren't facing too much risk in doing that, and they could do it in a way that was going to, they were going to have total peace of mind as well. On the side, they ended up setting up an ethical share portfolio or an ETF portfolio with a bunch of socially responsible investments to deliver some investment income and reduce their dependency on their income from employment. Both love their jobs, but wanted to create that freedom for their situation over time. The big benefit for them was clarity and confidence, both in their decision-making and the pathway that they were on. The value, which we quantify the value that people receive after paying our advice fees, $56,000 in year one, $4.4 million after year 20, which is pretty awesome. Our client problem of the month was going back to what I was saying about tax bills on RSUs, so employee share grants, that we got a client that got a ton of shares that they had. The company that had kicked a bunch of butt, and they received this like chunky six-figure number of shares that became available to them. Share prices subsequently got a significant whack, and they've got this tax bill that's accrued based on this really high share price. Now the shares have dropped them. One, they don't want to sell, but two, they don't have the money to pay the six-figure tax bill that's come with their massive share dip. So we're just working through how to tackle that issue, but it highlights the fact that while it's great, and especially with tech, and we work with a lot of people in tech, that as tech shares are rising, happy days, everyone's high-fiving all the way down to the E-Trade account. But when the markets go the other way, you are the one that's carrying the can, and it can be really challenging to work around. We're facing we've got a few different options in front of us. None of them are ideal, and a lot of them require a bit of hope that a few of the stars align to make sure that this isn't a bigger problem than we want it to be. Our mistake of the month is getting caught up trying to find the very best property investment. And this is something that we see particularly from analytical people, where you're looking at, growth rates, listening to these media stories, and you can get so caught up in that granular detail that you sometimes lose sight of the bigger picture and really what makes a good property, what is in demand, and how to take confident action and actually enter the market, as opposed to you just constantly spinning your wheels trying to find this perfect ideal property that doesn't really exist. And even if it does, you wouldn't know about it until much after the fact. The client money hack of the month is not looking at your money decisions in isolation. Because when you do, you lose sight of the bigger picture gaps in what you're doing. So sometimes going, I've got X dollars, I want to invest it, or I've got this property, what do I do with it? Or I want to buy this property, how do I do it? means that you can miss out on some of the other more fundamental or foundational gaps that could be holding you back with your money. So it's great to get granular, but you want to generally start at that 50,000 foot level, and then you can work your way down, making sure that the actions that you take in the lower levels are consistent with what you're doing up here. A success story of the month is these lovely clients that we've been working with for a little while. They went into the property market in the past and picked properties that didn't end up getting the growth that they wanted, pretty average properties in average areas, and they got a bit burnt. We started working together a couple of years back and spoke about buying an investment property based on the borrowing, the power of leverage and getting into the market. They were very nervous, but after making sure that our bases were covered with, money aside to cover if there was rental vacancies or if the growth didn't happen the way that they wanted, or if anything happened with their work that created issues with funding interest costs, they ended up going into the market. They've had this property for about 18 months and made a bunch of money off the back of it. And now we're getting to reload and go again, and they're feeling a lot more confident about it. They've made a bunch of money in the process, but more importantly, they're now feeling like they were already on a good path, but they now feel like they're taking advantage of their situation and actually making their money work for them, which is building a solid level of financial confidence. Guys, I hope you found that one helpful. If you like that, please share the love. And I'll catch you next time. Stay safe.